Hi, everyone. I'm very, very excited for today's wartime conversation. My name is Edith Young with Raise Capital. We have almost 300 founders and investors joining us from all over the world today. Wartime Conversation is a live discussion series featuring investors and founders whose ideas and experience can really help us to reflect, fight, navigate this uncertain time. And we are really honored to have three amazing speakers joining us today. Starting with Bill Janeway, is a special limited partner for Warburg Pincus. Bill joined Warburg Pincus in 1988 and was responsible for building the information technology investment practice and leading many amazing investments, including BEA systems. And we also have Alfred Chuang. Alfred is the founder and CEO of BEA Systems. From nothing, received investment from Build to public, to eventually sold it to Oracle for $8.6 billion. I often like to call Alfred the Steve Jobs of enterprise. And he's an amazing, amazing hero for many, many entrepreneurs in Silicon Valley. And then last but not least, we're very honored to have Gina Chon today. She is the West Coast columnist for Reuters BreakingViews. And Gina previously also wrote for Financial Times, Wall Street Journals, and many, many amazing publications. With that, I want to introduce our amazing speakers and let's welcome them.
Oh, thank you, Edith.
Thanks very much, Edith.
Thank you, Edith. And hi, everyone. Thanks so much for joining us from wherever you are. We're very excited to have a conversation with Alfred and Bill, whom you've heard from Edith go way back and have a lot of experience to share with all of us. So we're excited to dive in. And I wanted to start off, just given the craziness of this year and the unpredictability that continues, trying to put this into context in relation to past crisis situations, whether it's the 2008 financial crisis or the dot-com bubble before then. For Alfred and Bill, I wanted to get your thoughts on how this pandemic differs from some of these past emergencies where you've seen, in the 2008 financial crisis, it was largely the banking system and then the sort of fallout from there. This is a public health crisis that has also had devastating economic effects, and the way that's affected sort of tech companies and the ecosystem and financing has differed a bit than in the past. So Bill, if we could start off with you, especially given your economic background, putting that in perspective would be helpful.
This time really is different. We've had crises that have affected jobs and income and investment in the past, but this one is coming from the supply side. The supply side of the economy, not just in the US, but around the world, shut down. And when we shut down the private sector, the real economy in the past, the only time we've ever done that as deliberate policy was mobilization for war. There was never a shortage of demand in 1940-41 when the civilian economy was closed down because the military demand for jobs and the product of labor was absolutely enormous. So we haven't experienced something like this in terms of the real economy before. And that means that restoring the supply side of the economy is crucial to generating the demand that will put people to work. We've maintained liquidity, but we also have one other clear distinction. I don't think we've ever had the experience of this amount of unemployment, of bankruptcy, of cash crisis, even alleviated by some of the stimulus or the recovery bills, with the stock market reaching new highs. So the other thing that is different about this time is the way the Federal Reserve, the US Central Bank, and the other leading central banks in the world have all moved interest rates to unprecedentedly low levels, actually negative after taking account of inflation. That has done very little to stimulate demand, but it has enormously inflated the valuation of financial assets. We see that especially, of course, in the valuation of companies whose future profitability is very large relative to its current. And that in turn has funded or stimulated an enormous amount of speculative activity, particularly around venture-backed entrepreneurial startups. And that's something Alfred can speak about, I'm sure, with great knowledge.
Well, so I wanted to get to Alfred in a second, but I wanted to actually follow up on that point, because I think that aspect of how this crisis is different is maybe not talked about as much, at least in Silicon Valley. So what do you think that does to the dynamics of valuations and fundraising and financing? Because the Federal Reserve has made clear that they're going to maintain this position for quite some time. They were slow in normalizing after the 2008 financial crisis. It seems like they could be just as slow or maybe even slower. And, the Fed balance sheet is going to be, 4 trillion plus and all that for quite some time. So what does that mean for the tech ecosystem for startups and investors?
Well, for the time being, it means that raising money is unbelievably easy, that there's an enormous pools of capital going into venture firms or going side-by-side venture firms. Now, the unicorn phenomenon had already begun. It goes back to 2014, the notion of super high valuations for companies with not only no profits, but no prospective profits for an extended period of time, if ever. That itself was a reflection of the very low, sustained low interest rates that you just referred to after the 2008 financial crisis. That phenomenon has always been vulnerable to any normalization of interest rates, but it's also proved to be vulnerable on a micro basis, on a case-by-case basis, as and when these startups with extraordinary valuations and, let's say, imaginative business models, yes, I'm talking about WeWork, are actually exposed through the requirement that, thank God, the requirement of the US securities regulations, which have not been eliminated, for disclosing details about how they do business and what the financial results are. So we've seen a kind of micro undermining of confidence in the unicorn phenomenon, even while the macro environment remains remarkably favorable. I think that can continue somewhat longer, but there is a third vulnerability. I don't want to be particularly contentious about this, but one of the things, my reflection on a couple of hundred years of economic history, and particularly of economies driven by technological transformation, is that sooner or later markets need credible political underwriting. We've had that from the Fed, but we have not had it for some few years now from the White House in collaboration with Congress. So there is a vulnerability as we head into the last final quarter, if you like, of the presidential election and the congressional elections. There is a vulnerability to disruption from the political side that, frankly, tech entrepreneurs and most of their financial backers they're just not attuned to that. Yeah. They're not sensitive to the notion that politics, for good or ill, can really matter. And over the next 3 to 6 months, politics could really matter.
Sure. Well, we'll definitely get to some of the topics where they've already mattered in big ways. But Alfred, I wanted to turn to you and how this pandemic is different from past crises, especially because you as a founder and now an investor has kind of seen it from various sides. What do you see as sort of the opportunities even amidst all this pain?
So Gina, I only have 2 up close and personal experience with crisis. So obviously when the tech bubble bursted in April 2000, it was hugely impactful because it's almost instantaneous, because it was a public market, equity market bubble bursting, the stock market took a nosedive, people fled tech. So at that point in time, literally, I mean, first you see tech-centered area like San Francisco, the rest of the Silicon Valley, restaurants were closing, tech companies were going away, some of them went bankrupt, some of them, then it created also somewhat of a real estate crisis because all these companies went crazy and building these lavish campuses, and all those kind of instantaneously disappeared. And it was, tech took it extremely hard, right? And I'm going to come back and talk about what impact it has though. But then in 2008, in the financial crisis, man, I saw this right in front of us. BE was a perfectly great company. It was growing over 10%. We're generating so much cash as a great business. Bill have always reminded me, my boss has said, Alfred, if you don't generate a huge amount of cash, it's just not a real business. And it was really a serious, great business, and our install base was massive. But yet, I personally witnessed how Bear Stearns went under, and we saw a very large deal disappear, literally, that we were having received. And next thing you know, I was talking to the CEO of Lehman Brothers, and they went under. So that impact to the tech business was massive. I mean, it was something that was really something that was I was so taken back by it. So I ended up, we sold the company. So I think this time is very different. First, this is a global crisis. It's ginormous. It's affecting everybody, okay? So, and then on top of it, the way that all the countries are reacting to it, which we didn't have the last two times, was the stimulus, right? So we are printing a lot of money. We're supporting a lot of businesses. Despite that, what we don't hear enough is how many small businesses are literally going out of business. Earlier when we were talking to Bill, like in New York, how many small businesses, which there's such a large community of them, which can no longer sustain this, right? But yet we still are masking it at this point. We don't know how long this will be masked, but it was being masked, which we never had before. So I would argue the real impact of this crisis won't be felt until that stops. When that stops, we really feel it. And that's when I think the public equity market will get hit. So a couple interesting things obviously on valuations and also on funding. The public equity market is so insanely strong. The pipeline of companies going public is the strongest I have seen for tech for a long time, right? For years. So this almost sounded like crazy when you have the world in a pandemic, yet companies are being rushed to be listed in the public marketplace. And we see this news every day. So I think that really has a lot to do with the cost of money has become almost literally zero. So, and that obviously, once you have the public equity market doing this, it trickles down to all the private market companies. Now, well, we have to divide basically and look at this way. There are two types of funding scenario for private companies in tech. One, they're funded by existing, been around venture capitalist firms. So they have raised money, obviously through the time, especially in the last couple of years where obviously the market was highly inflated. So, and they have invested in the company also in those inflated valuation. So some of them, obviously, they will have to decide to continue to keep them going. So we do have that phenomenon. I see it, okay? And then you have a wholly distinctive type of companies, which are really either they really didn't raise very much money or didn't raise any money at all. And now they're heading into now a whole new world. So those companies have a very different kind of reality. They know this is going to be a long-term deal. It's not going to be an instant success. So it's bifurcated between those two. I've seen 150 companies, new companies, small little companies, that's new startups in the past 4 or 5 months. And literally, I can probably put these things into two of these distinct buckets as we're looking at investing into them. And it's very interesting. And that I have never seen before. I didn't see that in 2008. Clearly, I didn't see that post-2000 in the tech bubble. Now, the encouraging thing, though, is the following. If we look back, crisis, this one is bigger than anything. Crisis, even in the past, in the 2000 tech-specific public equity bubble bursting, and then the 2008 financial crisis, both of those, just look at what had happened. Post what we got out of the tech crisis in 2000, probably was the most impactful, one of the most impactful thing to mankind, which is one, internet, what we are using now. We wouldn't have this, we wouldn't be able to do any of this if we didn't have the tech bubble of 2000. That's very, very, very important, right? To all the e-commerce thing that we do today. Remember, Amazon was started before the last tech bubble. So, and because of the tech bubble, and because they were onto the right business model, they succeeded, and we now have such dependency on them. Netflix was another one of those companies. So if we would tell you back in 1999 that what we were going to be entertaining ourselves because we can't go outside would be all full streaming, direct streaming, a movie that people made yesterday, no one would have believed me, right? That's all came. I mean, that was a very, very serious stuff. And if you look at the last financial crisis and what have happened since 2008, social network, SaaS software, cloud, our mobile phone with the touch technology, and the whole gig economy with the apps, those all came in the past decade. So think about it. So if we didn't have the bubble bursting, we wouldn't have these technology because we would just cruise along and it would be murky. That distinct stop and restart allow the distinctive company to bubble up and create the stuff that we have. So I'm going to guess, just look at the compound results of tech, because the more technology you write, it's easier to even develop even more code. It's just how it works, right? Because we have more layer of APIs involved. So what will happen in the next decade will be even significantly more dramatic. I would say, just conservatively think, is at least 2 times more than what we have between the last 2 bubbles added up. So for technology, this is a very exciting time indeed, actually. But we have to do it right, we have to do it long term.
Yeah. I couldn't agree more that, in fact, the other dimension of why things are different now is the maturation of the digital infrastructure, both from cloud to the inside the smart device, which is indeed continuing to be augmented by applications of machine learning that mobilize data. But there's another dimension to this as well, and it comes back to, if you like, the political exposure. Yeah. And that is, we've seen in the digital markets a degree of consolidation, a degree of concentration, an increase in market power that is unprecedented unless you go back perhaps to the end of the 19th century and the rise of the great robber barons in the second industrial revolution industries like steel and petroleum, Carnegie and Rockefeller. And this has taken place in a complete absence, complete abdication of any kind of government oversight in the US, not in Europe, but in the US, as the antitrust laws were essentially liquidated through the intellectual revolution that came from Chicago. That is in process of changing. It's impossible to predict in any detail, which cases. Obviously, this is going to depend again enormously on the election results as to the timing, but I think you can take to the bank and start building hedges that the unconstrained market power and growth potential, including the growth potential fed by acquiring anything that moves that might contribute to market power or threaten existing market power, that's going to come to an end, and come to an end during this same forward-looking 10 years that you correctly speak about as likely to foster enormous innovation, particularly in the applications of digital technology.
Yeah.
So, Bill, that's a good way to get into some of the political questions that I'm sure a lot of people have in terms of how it affects the industry. As you are right, and I've been looking at this in terms of all the startups that Facebook, Google, Amazon, Apple, all the big tech companies have bought, even just within the last year. And there's been dozens and dozens of these deals, and they often fly under the radar and don't get the review that perhaps they should. And we saw the big tech CEOs go before Congress recently. And then the very next day, they all reported these blowout earnings that grew their market caps even further. So but you think that this could be coming to an end, especially, I'm guessing, if there is a change in the administration. Can you talk about just sort of the innovation economy, which I know is also something that you've been interested in, and Alfred as well, in terms of the environment for startups, and especially in the pandemic, where perhaps you're at a point where even with all the money out there and a lot of dry powder, you are still thinking about how to scale, and maybe these big tech companies and being a part of that is, one of the best options you see, or the pull of being a part of a company like that is hard to avoid, and what they can frankly do to you as payback, as we have seen in some cases,
Right.
if you think that sort of environment could be evolving perhaps for the better.
Well, certainly the data is clear that selling to one of the big guys versus trying to build a sustainable business to take public has become the preferred default option for most tech startups, both infrastructure that is contributing to the capabilities of the platform on the one hand, and applications leveraging the platform for the benefit of consumers. That's clearly been the case. Now, I see two different things going on. One, in the knowledge economy, there is clearly a movement building to reconsider how to think about competition policy, how to think about antitrust. For 30 years, the dominant dogma, the doctrine has been, if it doesn't involve raising prices to consumers, how can it be bad?
Yeah.
Well, when you have, when it's all free, that is nominally free, of course, it's not bad. But the antitrust laws were actually written with as much concern for what happens on the supply side of the economy as on the demand side. And that's why companies in the past were attacked because they monopolized the supply side, even if they weren't raising prices. And the two extreme examples, which everyone in the world is an enormous beneficiary of, two antitrust cases brought by the United States Department of Justice against the two tech giants of 2 generations ago. First, in 1956, the Justice Department sued AT&T, Big Bell, Ma Bell. This was not about breakup, but what it led to was a deal whereby AT&T agreed to give away its entire portfolio of patents for free. That was the patents for the transistor, for the kind of software which 20, 30 years later, we built BEA on. 15 years later, the Justice Department attacked IBM, which had gotten really a little out of control. They basically were trying to put a competing computer company, Control Data, which invented the first supercomputers, trying to put them out of business. Justice Department attacked, and IBM agreed, again, in a legal deal with the Justice Department, with the US government, to unbundle software, to create an independent software industry. Well, just think about the incredible contribution to innovation, to entrepreneurship, to startups, because of AT&T's patents, the largest patent portfolio in tech in the world, and an independent software industry, both created by antitrust initiatives from the US government. So anyone who worries that an active US competition policy would be bad for innovation or entrepreneurship should go back and study those two critical historical examples. And I think they'll come away with a much more positive sense of how an active concern from government for the competitive conditions in markets is a major contributor to innovation and long-term growth for the benefit of all.
Well, Alfred, how do you think that affects the enterprise side of the house? Because so much of the public attention has been on these consumer-facing companies, but we've seen, Salesforce do a lot of deals. There's a lot of deals in the cloud space that don't get as much attention, but could still present some anti-competitive concerns.
Actually, first, very well said from Bill, but there are two set of issues that's combined here. One is the antitrust issue, that these companies are becoming so dominant that smaller players have a hard time, innovating new stuff around them because they will squash them. So now I have personally witnessed the effect of the consent decree that the government has placed on both Microsoft and also on IBM. But it allowed literally the BEA to exist. If BEA would have started the company that IBM was basically, was not on a leash, there was no way that this would have happened. I remember my first meeting with Bill back in 1994. I said, Bill asked me, so what do you want to do? I said, well, I want to kill the mainframe. But he laughed and he said, well, I'm really interested how we're going to do that. So that would have been totally a joke in 1994 if there wasn't such constraint and what the government has made available for us to compete and brought basically the modern day distributed computing, right? So if we didn't do what we did in the 90s and going into the 2000s, today computing would have been very different, would have been stifled. So I think it's crucial that most definitely, both on the demand and the supply side, that certain constraints be placed. So I'm very confident that history will likely repeat itself because people love innovation. So we're going to get tired of, all this mumbo jumbo, when things are basically being squashed and we can't have it. So I think that justice will prevail. Now, on the other side, there's a whole different issue, which is more political, which is then we have the issues like TikTok, okay, which they really have gone and reinvented, at a global level, right, of technologically how people wanted to be able to get addicted and adopted to be entertained. Very different from what we have invented back in the late 2000s, right? So, and now, obviously, because of politics, some of those interesting actions have been being taken. We don't know how it's going to end yet at this point in time, right? But that's a very different type of phenomenon that we really have never seen before. So that really is a new chapter that is yet to be played out.
So Alfred, building upon that, how do tech companies, whether you're a founder, CEO, or investor, deal with this situation that is so fraught and contentious and largely out of their hands, but you're still having to deal with the fallout of this, and who knows where this could go? I mean, seeing, President Trump himself basically, become an M&A banker and try to orchestrate some of these deals, whether WeChat does end up getting banned, sometime in 45 days, and the whole push from the American side to have a so-called clean network, which we've heard Secretary of State Mike Pompeo roll out recently. How does that affect what had been, at least ambition-wise, a global tech system, and having platforms that are global and you can access them and they're the same, whichever country you're in? And obviously, China doesn't allow certain US tech companies to operate there, but for the most part, that had been an advantage. And if we see, a balkanization in some ways of these tech companies and services, how that affects the ecosystem.
So Gina, I'm not a political commentator, so I'm not going to get into the political part, but,
Sure.
But I think one thing probably is warrants to discuss, maybe trying to just spend a minute or two to discuss what are we dealing with here, right? So, and I think it's very interesting. I really haven't seen much of any publication to talk about what really had happened with like a technology like TikTok. TikTok was started by two guys in Shanghai in an apartment. And they basically wrote a technology that was pivoted a few times, not dissimilar to tech company we have here. And then it was just, it was a karaoke singing application for young teens. And it evolved, and it has seen a level of adoption, but then they plateaued. The company got sold to ByteDance. ByteDance really was a newsfeed company, but what that ByteDance has really done really, really well, the biggest market for ByteDance up to that point when they bought TikTok was not in China, was India. So, and the language was Hindi. So it wasn't even a language that these people understood. What they have developed was basically machine learning algorithm to understand what people like. And how do we make them so addicted and feed them more in a very urgent manner? So this is very different from anything that we have ever seen, because up until that point, we rely on social-based network, which is like a Facebook, like Instagram, like a LinkedIn, because I write about things, you read about it, right? You subscribe to me, then you join the network, you started publishing, other people looking at your stuff. That's the connections were the primary purpose of securing that network itself. But that's not the case for TikTok. TikTok was all purely, just like the parents company ByteDance, all get to prominence because they were able to learn what people's behavior is. They learned to a point where they know you started watching this stuff at 9:30 at night, which you're in bed. And then you kept, watching it, that you can't stop. You don't go to sleep anymore. And they know all that. And I think that caused people off balance so much that we were so stunned that this could actually happen. Yet the most technological innovative country in the world, like the US, have not developed such, what we call machine learning or artificial intelligence technology that was so far ahead of our time. So this, I think, really is what had happened. So now, what the politics is trying to do to it is totally different, which I don't even know how they'll be able to take the US operation out of TikTok and leave ByteDance alone, because the algorithm and all the key drivers is back being run inside China. So this is I think is to be resolved, and I think it's amazing how we get to here. Now, Bill is a huge proponent for globalization. So am I, right? Because that's the whole point of being in the technological field. You can be anywhere. The technology is to propel mankind. It's not to propel one country. It's not possible to contain it that way. It doesn't make any sense. It wouldn't work either, right? E-commerce is about commerce and enabling it to do very quickly. The efficiency comes from globalization. So I just personally don't see this is viable even over time to try to constrain it by geopolitical reason. And some people do believe that, well, there's going to be a Chinese firewall, soon there's going to be an American firewall. Bill and I actually had a discussion a while back about globalization. I said, well, it's entirely possible if we keep going this way, we may be going down the path that we are doing globalization without the US, right? Which it's a travesty if that happens, right? We are the people that talked about globalization was entire time of the nation. So this is interesting time with that.
Alfred, if anybody wants to go on my website, billjaneway.com, they'll find that the most recent writing I published is called The Retreat from Globalization, which discusses different aspects, the different channels along which the globalized economy is fragmenting. We've had fragmented global economies before. We had enormous globalization by those standards at the end of the 19th century. By 1945, there were completely distinct economic, financial, and political regions of the world, which the US in those days set about breaking down the barriers and reopening the world, not just to commerce, but to shared ideas. But we shouldn't be shocked, because what you just said, Alfred, points up two very different phenomena, which are both very relevant to the US-China relationship, which is so central to the future of the world as well as to our two countries. One is China's at, if not beyond, the technological frontier. China's no longer catching up. It's no longer catching up in silicon production, although it is still just catching up in silicon design. It's certainly not behind the frontier in machine learning and the application of machine learning, as TikTok demonstrates. So the old story that we invent and the Chinese steal, well, that's about as dead a story as by the end of the 19th century, For 100 years, Britain invented and the US stole. That's how we got a textile industry. But by the end of the 19th century, we were inventing and the British were falling behind. So the first question that points up is it inevitable? Not just that there's contestation between the US and China, but that US falls behind because it goes into a protectionist mode as the British did and loses the cutting of innovation and entrepreneurship. That doesn't have to happen, but it definitely could. The second thing you pointed out was the intimate degree of deep engagement between the Chinese and the US demand, supply, and value chains. Now, undoing that could be done. I mean, it happened between World War I and World War II. It could happen. It would be unbelievably painful for all concerned. But there is another alternative. And, you know, as you may recall, Alfred, I've said that I'm doomed to be an optimist because otherwise I couldn't have survived as a venture capitalist. My optimistic take on this is that there is a common threat. Let's not call it an enemy. It's not individuals, it's not a nation state, it's nature, it's climate change. And there is no more needed collaboration between the United States and China, the two largest producers of CO2 in the world, to collaborate on not just inventing the new technologies, not just the non-carbon using energy sources, but the ability to store and manage that energy, but also on deploying it at scale and at scale globally. That offers to me in another administration a possibility for, it may be a frenemy collaboration, but there is so much to be gained on both sides from working together to, let's say, mitigate the damage that has already begun to be done by climate change. That's my optimistic longer term take. And it will depend on intimate scientific, commercial, and economic collaboration between the two countries.
Well, I wanted to also get back, because I know we wanted to get to questions from the audience in a bit, to go back to the markets and what we were talking about in the beginning in terms of the sort of divide between sort of the real economy and what's happening on the NASDAQ and other exchanges. So for investors and for founders who are looking for exits, we've seen various sort of new trends recently. We've gone the direct listing route, where a lot of times, whether it's Spotify or others, aren't actually raising capital. It's more to give liquidity to their employees. And that's caused some controversy, especially here in Silicon Valley, between sort of investors and bankers, and who's losing and who's winning, and what kind of money is being left on the table. And other phenomena from other players in the sector, whether it's these SPACs that are all the rage now, these special purpose acquisition companies that are essentially blank checks. You're just forming this to basically buy another company. Bill Ackman has been very vocal about his own search for a unicorn in that circumstance. How does that shake up the tech investing environment, and for founders thinking about what's the best way to go financially in the future for their company when they have various stakeholders to also consider? And Bill, if you want to take that first,
Sure.
And then Alfred.
Sure. Well, first, a couple of things. One, in looking at the big stock market, there's another thing that's different this time. I just, again, in the Financial Times this morning, noted that the big four mega tech companies, their stocks are up 23%. The rest of the S&P, ex those companies, is down 7% year to date. So the extraordinary dominance of the financial valuation of these companies, which are enormous beneficiaries of the lockdown. We didn't say this, but there is something about the pandemic and the impact on the real economy that is very distinctive. It has probably accelerated by a decade or more the kind of innovation, the deployment and use of the sort of innovation Alfred was talking about. The extended digitalization, whether it's working from home, whether it's learning from home with the schools closed down, that both requires, of course, building out the cloud faster and faster, but it also means innovative applications like Zoom that none of us had heard of 18 months ago. Now, how many hours a day we spend? Many of us spend a hell of a lot more time on Zoom than we do on TikTok, I gotta tell you. So that's one aspect of it. Second, the IPO market since 2000 has been in a long-term regime shift from the way it was for the previous 20 years. There have been relatively much fewer IPOs of venture-backed companies, down to a third to a quarter of what we took for granted in the previous decades. Most of that is given, people say, well, it's so expensive to go public. And of course, if you have private money available at a premium valuation, why would you go public? There's another factor, it goes back to the market concentration. It's not just big tech that has dominated its markets. In the investment banking world, in the world of the intermediaries, the banks that take companies public, that concentration is even more extreme. Once upon a time, there were 20 investment bankers of significance. Now there are 4. And they are so big, they're only going to answer the telephone, or rather get on a Zoom call for a deal that's going to earn them hundreds of millions of dollars. So you have to become so much bigger along at least some dimensions, not necessarily cash flow, in order to be able to go public, that very much fewer do. And as I've already said, and as it's in the data, 85 to 90% of all successful outcomes for venture-backed startups are by selling the business, not by any kind of going public. The number of companies that are going to be able to do direct listings, very few, very few. They're going to be subject to scrutiny, and they do still, because their shares are going to be traded, they still have to file with the SEC.
Yeah.
And that means that if they have the WeWork business model, they'll be laughed off the court before they get the chance to play the game. The other thing, the SPAC, we have this phenomenon come back again and again. It was in the roaring 20s, in the run-up to the crash of 1929. There were exactly these kinds of speculative blind pools, is what they were called. You give me your money, and after I've done something with it, I'll tell you what I did with it. This is an extreme bull market, cheap capital, transient phenomenon. You shouldn't build your structure of how to think about financing your startup, which is going to change the world over the next 10 to 20 years. You shouldn't think about it in terms of Bill Ackman's SPAC being the vehicle for getting you the funding resources you need.
So Alfred, you also wouldn't take Bill Ackman's SPAC?
So Bill, very well said. And obviously, I've seen a number of these things being presented to me to try to make a quick buck, too many times. Now, let me just talk from really my typical advice to give to young entrepreneurs. What do I say to them? It's very critical to think long term. There's always that hero worshipism that goes on. But people don't look at the data, right? The data is the really successful companies that the most successful company, and then you look at that list of Amazon and Apple and Netflix, and the list goes on. They've been around a long time. It was not an overnight phenomenon. Rarely, even if they were really overnight, they gone through some bumps, and over a very long period of time, you've seen very dramatic wealth creation, and then they become a household name, and then they place an importance in the world, what most entrepreneurs set out to do, right? They want to change the world. But then what had happened is because the economic conditions, and also, like when I was building a company back in the 90s with Bill, it was our path was actually much simpler. You raise Series A, Series B, Series C, Series D, you do a mezzanine, and then you go public. And when BEA went public, we were very small. But yet, there were enough hedge funds, right? And that the hedge fund scene was very different. There was small enough hedge fund that they can place enough bets that they can still support and look for the future growth with the public money, right? Which really what the public want to do, right? That's the whole reason why there is a public marketplace existed for all this time. So I think we sometimes have forgotten the reason why we get here. So when I hear an entrepreneur and they argue with me, I say, well, Alfred, my pre-seed fund, pre-money valuation really should be $1 million more. And I'm thinking, I said, you're prepared to lose a great investor to be working with you all the way through this journey for $1 million in this stage, which will become totally meaningless downstream, right? I mean, it goes back really to my journey with Bill. I mean, Bill committed $50 million to BEA. That was the only private money we ever got. Warburg Pincus got close to $7 billion in return. The reason is not because of any other circumstances than we looked at it very, very long term. So Bill not only invested in the company, they didn't sell at the IPO. They didn't sell in the run-up. They didn't sell, through the bubble, right? And we went through 2-3 more pivots before we got to become so big and our revenue becomes so enormous and our install base becomes so solid. That really is what tech is about. And I always have to remind people, that's the reason why the stock option vests in 4 years. Generally in software company, especially enterprise software company, need at least 2 times those, 8 years to get somewhere. So if you're not really prepared to do that, why do a company? Why found a company? Because that's just not how it works. To change
Alfred, one quick aftermath. One thing that you got and that your team at BEA got was something I preach all the time. As soon as you can pay your bills because your customers are giving you more money than it costs to build and deliver what you're selling, that means you are liberated from dependence on the financial markets, on investors. Corporate happiness is positive cash flow, and fighting to get to that stage is the critical step towards reaching the ability to change the world, as Jeff Bezos did at Amazon, as Bill Gates did at Microsoft.
So, Bill, that's actually a perfect segue into some of the audience questions.
Right.
And I'll combine some of the ones that are similar. One of them focuses, or 2 of them, I should say, focus on your thoughts on what areas you see as most promising in tech and sort of this post-COVID, although I guess we're not post-COVID yet, environment. And I wanted to add something to that for both of you, which goes back to what you were saying, Bill, about cash flow, where before the pandemic hit, doing great in an environment where, at least in the United States, the unemployment rate was at a 50-year low, GDP is humming, all labor market slack is fairly tight. There was a lot of things going for the economy, and it was, maybe not as difficult to do well in that environment. Given where we are now with, as you say, the supply shock side, what are you seeing and what are you looking for in companies? Obviously, you want a business model that you think has a future and there's growth potential there. But in terms of what you want to see in a founder or a CEO, where their head is and how they're dealing with this kind of situation, what are the qualities that both of you are looking for, in addition to the sectors that you think would be the most promising?
So those are 2 separate questions. I do think that there's a very broad spectrum of opportunity for specific applications of machine learning technology, of the different types of machine learning technology. Note that I never use the term AI. Anytime you hear somebody say artificial intelligence, you're being promoted. You heard that here. But machine learning, deep data analytics, delivering real-time response to evolving, fast-moving data streams. We're just in the early stages of learning how to apply that. For the entrepreneur that does have an application, I think it's going to be very important not to overhype and overpromise and say, now we've solved artificial intelligence. What we have is a better application that produces better results for our customer, usually the business customer that in turn delivers the final service, but it may be TikTok. That's one. The second thing is really kind of countercultural. I'd like to look for scars. I like entrepreneurs who've been through the valley of death. The founders of BEA all came out of Sun Microsystems. Now, very few people, maybe Scott McNeely remembers, that around 1990, Sun Microsystems went through the valley of death. It was really struggling as it tried to move from being a workstation company to an enterprise server company attacking IBM prematurely because it didn't have the software for its boxes. And the fact that Bill Coleman, the B, and Ed Scott and Alfred Chuang, the E and A, had all been through that kind of experience was enormously confidence inspiring to me because they had to operate under stress. It hadn't all been just upside. What I don't look for is a golden CV, a golden resume from some company that, like Facebook, has gone from 0 to infinity without missing a beat. And there's always been more cash and more free food and more goodies around, because building companies is really hard. And as Alfred knows, I always used to say that doing a startup in order to put technology to work to change the world, that is the worst. You only do a startup because there's no other way to do it. You don't have an existing business. Startups suck. You have to spend so much time on stuff that creates no value, like renting space, particularly if you don't have WeWork anymore. So you want people, you really want to back people that you be in the foxhole with, and you'll know that they'll cover your back because they've learned that that's the only way you survive when you're trying to build something really important from scratch.
Alfred,
what goes that I want to tell a little Sun story that I think will entertain all the people that who are calling this call. In 1989, I was asked to do a task for Scott McNeely, which I really didn't understand the context of it. But I went with a ton of our desk-side server on a plane that we have borrowed, leased from FedEx. We went to Narita in Tokyo. And we get to the airport, and we were supposed to ship all these machines to a company called Fujitsu to deliver it to them so that we could actually make enough revenue, which I didn't know why. It was because we were hinging on a loan to make payroll, which was going to due days later. And so that deal was secured through Mitsubishi Bank, and then they said, you have to ship this many machines. So I ended up on the fly. I said, well, logistically, we just couldn't get there because it's just going to be, the trucks are too small, it's going to take too long. So I ended up on the fly, we negotiated a deal with Fujitsu. We said, well, let's just do it at a hangar. So we rented a hangar. I painted a line using a spray paint, which was a taboo in Japan, so you ended up having to paint the floor. And I said, well, what about this? What does it take for you to accept these machines? The terminal said, you have to be able to run diagnosis. So we're now doing the most destructive thing. We're assembling the computer in an airport hangar. As soon as it runs a run-through diac to the level, we push the thing over the goal line. We barely made it. So that's, by the way, and then obviously years later, Sun had Java. It became a massively successful company and have tens of thousands of employees. People have forgotten what it took to get there. I mean, those are war stories that people don't really hear about. They just hear about the good stuff. So go back to your question really quickly. There are lots of things I'm really interested in. I firmly believe the next generations of application, whether it's enterprise or consumer, all will have collaboration in there. We'll be able to do video, we'll be able to do texting, we'll be able to do drawing on a whiteboard, we'll be able to communicate as if we're in the same room. Every application will have. So this is different from what we have now, which is just the application, but we'll be embedding the software everywhere. So this is going to need a whole new generation of infrastructure. Banking is going to change because people don't do consumer and commerce, like commercial banking anymore, because you can't walk into a branch. So digital banking embedded in the application is going to be crucial. Data, super, super exciting, because now we don't just need to analyze data that we can see. Like we're now already experiencing, we want to peg our any data, financial data, whatever data, to the COVID data because we want to see the trend. But we can't see the inside of the data because it has personal privacy issues. So to be able to analyze those kind of data, super critical. So we are just about to embark on such deep innovations to enable the world that has to come about for the next decade. Is super interesting. So what kind of entrepreneurs? They got to be somewhat tough, because you can't just get there, because these are such difficult problems to solve. There's no way we can solve it in one shot. We're going to be going through some diving and turning and pivoting constantly. So find partners that will do that with you, whether it's your investors, your co-founder, or your employees. Forget what had happened. Look out the window, look far. If you want to change the world, pay the price, and we'll get there.
And I think we have time for one last question, and this goes to the future as well in terms of the work from home phenomenon and how that affects the tech industry, but also the economy writ large in terms of where you see opportunities. And also, I guess, for both of you, how do you find those gems now when a lot of the traditional ways of networking, meeting people at a cocktail party in San Francisco are have all gone by the wayside, and you're relying on Zoom pitches and virtual road shows and all that. How are you sort of still finding good companies in this space?
We've seen this through the generations of successive communications technologies. You've seen that you need less bandwidth the better you know the person on the other side, right? So now we have Zoom, which is so much more bandwidth than we had with steam-powered telephones 40 years ago. But I really do believe that valuable and how we've learned to interact in this way. This is very good. We have a lot of bandwidth here, but Alfred and I have known each other for 26 years, and we've been in the trenches together. So we can really finish each other's sentences, and we understand what each other's questions mean. But if we were meeting for the first time, we would really want to be face to face. The line I used to use when I was really out there on the frontier was when we're really getting into deciding, yes, we're going to do this, you'll want to be able to smell each other's sweat. You can't do that over Zoom yet. So I think that good as this technology is, it's not a complete substitute. And there will still be gains from being near each other physically as well as technologically.
And Bill and Gina, I think there's no doubt, by the way, this pandemic will end, right? How soon it will end, we don't know. I mean, the efforts and the science that's being put into it are totally astonishing. I'm on the board of a university, and we have a hospital. I'm very close to the kind of therapeutics and work that we're working on. Those are actually super promising. So maybe we won't be able to get a perfect vaccine for a while that will be able to just cure all. Right. But I think we'll be able to find therapeutics that will prevent, large amount of deaths. So then all people can actually recover from it. No different from how Fairfield was able to help us to recover very quickly from an influenza in that fashion. So I do think that we should expect we will go back to some level of socialization because our species is based on that. It's our nature. However, I think what is the sign of the times that we will have to accept is this has started a new generation of decentralized company. So companies don't really think about, I have to headquarter here, and everybody's the employing people only in those, free floors. Right. I think that phenomenon clearly has gone away. So, and that, by the way, is easy. There's not one company that I've met over especially the last 2 months, that little companies, they'll say, oh, we're all in this one place, and then we take turns to go to the office. I've never heard of that. Generally now they will start with the sentence, we're fully decentralized, because they think that's an advantage. So if the little company in tech start that way, then the larger companies, which there are a bunch of them, look at Spotify as a company, they started as a decentralized company, so it's possible. That doesn't mean we won't socialize, right? Because that shortcuts so much stuff. Looking somebody in their eyes and feeling that what they said is what they mean is crucial. And that will come back, but the way that we're going to use an office for that will be quite different. So I think that mix is going to be crucial. So, but one thing, look back, it's a caveat though, we don't have those tools yet. Wait until we see those phenomenal tools to allow us to have culture and processes to be implemented through this decentralization process. Then by the time that we go and meet the person in person, it'd be so much more productive. I'm pretty sure of that.
Yeah, well, a lot to hopefully look forward to, as Bill says, being an optimist in the future. So I think we're out of time. Thank you so much to all of you for joining us today for Wartime Conversations. And thank you so much to Bill and Alfred for their great insights.
Thanks the audience. Thanks Bill, and thanks Gina so much. Yeah, it's very good to see you all. Appreciate it.
Long life and prosper.
Yes. Until the next time, cheers.